Good evening, ladies and gentlemen. I welcome you all to this last in the series of discussions today, which is on the topic changing paradigms within the global fixed income markets. So let me kick off by the discussion by taking you back 7 years. So 2007, around this time, we saw the credit crisis, coming out in open. Which actually initially started with as a liquidity crisis. So initially there was the liquidity in the global financial system kind of dried up, and because a lot of the banks had exposure to the subprime mortgages. And about a year into the crisis, then we saw the Lehman debacle, which actually aggravated the crisis even further. People kind of stopped lending to each other, the whole markets froze. Another year into, so about 2009, late 2009, when the sovereign issues started coming up, and the crisis moved from, it kind of became an all-out crisis, and the banks who had exposure to sovereign bonds again were in trouble. So then how did we get back from there? So it was first the central banks who kind of stepped in, and they kind of brought down the policy rates, and they came out with a lot of measures to put liquidity into the system by various programs. And then we had the regulators who then stepped in with the set of regulations to bring about more transparency and to instill confidence with the right set of regulations. But then it also had a flip side. The flip side was that the traditional investment banks, their roles changed. So they were not in a position to hold the bonds. The trading limits were curtailed substantially. So those kind of things were happening. People started trading more on exchanges, and that there was a lot of. The idea was that there will be proper reporting of all the trades, OTC trades which you are doing. So all those things happened. So how did India, even though India did not have any exposure to these markets, these particular subprime assets, Indian banks did not have exposure, but still we were impacted. Our growth decelerated. But of course, the government stepped in with the right stimulus packages. The central bank stepped in to make sure that the funds to the productive sectors are made available. So now where we stand now? Today, all eyes are on US, eyes are on China, Japan, and of late, suddenly people have started looking at ECB as well. US because in 1 or 2 months from now, probably the stimulus package will be over, so all their bond buying program will be over. China itself is in the process of rebalancing their business in a way, their economy in a way that they are focusing more on internal consumption and services. Japan will probably be the liquidity provider to the global economy, and now people have started talking about QE by ECB as well. So with this kind of background, I would kickstart the discussion with the questions. So my first question is to Dhawal. He monitors the global macroeconomic situation closely. So Dhawal, the bonds sold off sharply when Bernanke last year in May talked about tapering. But eventually towards the second half, we saw the markets kind of stabilized. This year, the risk appetite kind of seems to be coming back to the markets, and the US bonds have done very well. So could you give us a sense of what's happening, what's going on?
Yes, I think it's very important to understand what happened in 2013 and what's going on in 2014. I think for the first time in month of May in 2013, when Bernanke talked about prospects of tapering, I think what he had in his mind was perhaps the idea of protecting the financial system of the United States or bringing the financial stability, because there was a very high level of fear that the way Fed was ballooning his balance sheet and it was supposed to approach $3 to $4 trillion, they were not sure how to unwind. So at some point of time, they had to take the money out of the banking system, and that's when Bernanke mooted the idea of unwinding through tapering, and the market participants completely got unaware. And in the aftermath of that discussion, we have seen bond yields rising worldwide. In the US, the 10-year moved away from about low of 1.5 all the way to 3%. And in the emerging markets, the yields went up between 200 to 300 basis point high. But subsequently, what happened was that Bernanke realized that the United States borrowing capacity was going to not get rolled over. And as a result of which, the tapering, which was supposed to start in June, July, got delayed till December. And that gave the world markets a little bit of breather or the opportunity to strengthen the financial systems. And luckily for us, I think Rajan had just taken over at that point of time, and he vowed to make our financial system bulletproof. So a lot of emerging markets and the global markets got time to strengthen the financial systems. And that's how the bond yields, which went up between May and August, had started coming down because of that breather. What happened in 2014 is completely different. To our understanding, when Janet Yellen took over as the chairperson of the FOMC, the tone changed. I think the FOMC started paying more emphasis to the growth prospects rather than stability of the financial system, which was in 2013 was the paramount topic. And when they realized that the growth in the United States was not as robust, then they started giving more proper guidance and communication, and as a result of which the market participants were able to predict when the Fed would start raising rates. And as a result of which, looking at the language, looking at the data, I think market participants are now hoping that the first rate hike by the Fed would perhaps come in Q3 of 2015 or later. Although the way we understand is that the earlier the Federal Reserve governors were asking market participants that why are the rates so low, and now I think they are trying to communicate in the sense that why the market is so behind the curve. So earlier they were basically trying to tell the market that rates are not going to go up, and now they are trying to communicate to the market that rates will go up faster. So the way the Federal Reserve itself is fractured, and there are hawks and there are doves, I think it's going to take some time for the market participants to realize that the Fed is going to raise rates. But in the meantime, as you rightly pointed out, that in Europe there is a significant amount of slack, and that slack is what is driving market participants to the US Treasuries, because the yield difference between the US 10-year and the European 10-year is as high as about 150 basis points, particularly if you compare with Germany to the US. So the flow of funds is what is driving the rates lower, and I think it's going to be a challenge for the central bankers to be able to take all this money out of the banking system and bring some amount of stability. But as of now, the law of gravity is prevailing.
So in case, let's say somewhere around Q3 next year when the rate starts going up, what do you think would be the impact on emerging markets?
Well, I think if you compare the experience of emerging markets with 2013, I think as compared to 2013, we have seen a significant amount of improvement in the balance sheet of emerging markets. The macro factors have improved, current account deficits are low, the financial deficit, fiscal deficits are under control, the FX reserves are high, for FX borrowing is low, and more importantly, the real interest rates are now positive as compared to negative in 2013, and the credit spreads are a little tighter. So my sense is that if you put all these factors in place, my sense is that when there is a withdrawal in 2015 sometime, there may be some impact on the emerging markets, but not as a whole. There will be some economies which will get caught on the wrong side depending on how much flows that they receive. But to generalize that they will have the similar kind of fate that we saw in 2013 will not be a correct statement.
Okay. So my next question is on the role of Japan. And this question is to Sujoy. Since Japan will be the driver of global economy because Fed will stop pumping liquidity in the system. So how do you see emerging markets benefiting from it in terms of which markets do you think would benefit? Because Americans will have their own investment style, their own risk style, and Japanese, on the other hand, would have a different style.
True. So I think, yeah, that's very rightly put, Rajeev. I think the psychology of Japanese investors are quite different compared to the psychology of US investors. Our sense is that Japanese investors are far more risk takers. They would like to play the speculative bet a little more compared to, or probably much more compared to an American investor. An American investor would be far more driven by the risk-return trade-off, so on. So I think all countries which probably stand out in terms of a very rich risk-return trade-off, I think are the places that a Japanese investor would look at. And we are quite certain that Indian economy would be one of the economies that a Japanese investor would surely look at, because currently the position and the valuation of the debt markets are currently trading in India. I think it's one of the most sought after destination as and when global flows, particularly from Japan, pick up over a period of time. And around the same time, in case as interest rates go up in US and there can be some withdrawal of liquidity from US, our sense is that Indian economy probably might be very least impacted, because maybe RBI is using the time available to him between now until the time our US actually raises rates to bring down inflation. So while we are quite bullish about Japanese flows getting into emerging markets where there is a high risk return trade-off, and India possibly stands out a big chance in terms of merit, we also feel that around the same time, while US overhang of liquidity or the carry trade money which goes away, Indian economy probably would be the least impacted at that point.
Oh, so then we are talking of a lot of, so then it's a good time to invest in fixed income bonds, I would assume.
Absolutely.
Okay, my next question is to Ramraj. It's on China, which is the darling of all the debates today. So are the recent concerns around NPAs in China for real? And if there is any losses happening out of China, will that mean a gain for emerging markets or loss for emerging markets?
Yeah, Rajeev. So I think China has been this debate about China and its non-performing assets has been around since many of us have joined the fixed income or credit rating space, which could be in the mid-90s to maybe even earlier. But I think the issue in our perspective is real. Some of it is already evident. A lot of it may not necessarily be evident because of the structure of shadow banking, which is followed quite prevalently in China. So the concern is for real. And I think on the other side, however, though the concern is for real, the reality is that the country has also had a stellar track record of having handled a fairly large NPL problem, a few years earlier. They have the financial muscle. The country, in terms of its reserves or in terms of its ability to capitalize